Picture this. One man speaks and entire markets tremble. That man is Jerome Powell, a 71-year-old who commands one of the most significant seats in global finance. The Federal Reserve is like the unseen hand guiding the U.S. economy, ensuring employment, stabilizing prices, and moderating interest rates. It's a role that makes Powell one of the most influential figures in global finance. But how did a man with no traditional economics background come to hold this monumental position? And why does a single word from him have the power to send shockwaves through financial markets? To top it off, there's the recent market crash in Japan, a crisis that's rattled economies worldwide. Can the Fed, under Powell's leadership, shield the U.S. from the ripple effects? Jerome Hayden Powell, often called Jay, was born in Washington, D.C. in 1953. The son of a lawyer, he earned a degree in political science from Princeton University and a law degree from Georgetown University Law Center. His career began in the trenches of investment banking and law, far from the usual economist's playbook. In 1984, Powell entered the world of finance and soon found himself working for the Carlyle Group and as Undersecretary of the Treasury for Domestic Finance under President George H.W. Bush. His diverse background was an asset, not a hindrance. In 2012, President Barack Obama noticed Powell's expertise and appointed him to the Federal Reserve Board of Governors. By 2018, he was elevated to chairman by President Donald Trump. Now, he sits at the helm of the Fed, guiding the U.S. economy. But has Powell's background been a disadvantage, especially with the recent market crash in Japan? On August 5, 2024, Japan's Nikkei 225 index plummeted by 12%, the most significant drop in decades. Why? The culprit is something called the carry trade. Imagine borrowing money at no cost and investing it in assets that promise high returns. This is exactly what Japanese investors did by borrowing in yen with almost zero interest and investing abroad. But the Bank of Japan's decision to raise interest rates from near zero to 0.25% triggered a financial maelstrom. A seemingly minor hike had profound effects, making yen-dominated loans more expensive and forcing investors to sell assets to repay their loans. This led to a vicious cycle of asset liquidation and soaring currency values, culminating in a market crash. This isn't a black swan event, a rare, unexpected anomaly, but a gray rhino event, which has been anticipated for years. The ripple effect was global, with the Nasdaq and S&P 500 both taking hits, and cryptocurrencies like Bitcoin suffering significant drops. Now, all eyes are on Powell. Analysts are questioning his delay in responding with a potential interest rate cut to buffer the U.S. economy against these global tremors. With a recession looming, record high unemployment, and eroding investor confidence, Powell's next moves are crucial. Quantitative easing, QE, is a powerful tool the Fed uses to invigorate the economy. The idea is simple: buy government bonds and other assets to inject money into the financial system, thereby lowering interest rates and encouraging borrowing and spending. Therefore, QE aims to stimulate economic activity when traditional methods, like adjusting interest rates, are no longer sufficient. But there's a catch. QE can be a double-edged sword. On one hand, it can boost economic growth and stave off deflation. On the other hand, it risks creating asset bubbles and increasing financial instability. However, with the U.S. facing potential recession due to global market disruptions, the Fed's approach to QE is under scrutiny. As Jerome Powell contends with the aftermath of the Japanese market crash, his decisions are more critical than ever. The interconnectedness of global economies means that what happens overseas can quickly impact the U.S. Therefore, Powell's strategy in addressing the economic fallout is crucial. The Fed's policies must not only address domestic concerns, but also consider the international ripple effects. Hence, Powell's ability to make timely, well-considered decisions will determine whether the U.S. can weather this storm without falling into a deeper economic crisis. The stakes are high. If Powell fails to act effectively, the consequences could be severe: further economic instability, increased unemployment, and a prolonged recession. So, what lies ahead for Jerome Powell and the Federal Reserve? The path forward is fraught with uncertainty, but it is clear that Powell's decisions will be pivotal. As he steers the Fed through these turbulent times, his leadership will be tested like never before. Therefore, as Powell navigates these choppy waters, his actions will be closely watched by investors. The outcome of his strategy will shape the U.S. economy's trajectory for years to come. Thus, the world waits to see how Powell will manage this unprecedented challenge.